so in love with you.
Welcome back to Real Estate Mindset. And what I can assure you guys is this video right here is going to be the most absolutely bonkers video you watch all day. It's how recession impacts the housing market. So today what we're going to do is really dive in to really look at history and see how a possible recession will actually, what that will do to the housing market. Now, obviously it's looking more and more like we're going to go into a recession every day, from lack of consumer confidence in the economy to increasing interest rates and to lawmakers that are essentially taking away quantitative easing and changing a lot of safeguards that were in place as we went through COVID. But today, what we're really going to dive in is the economic indicator, which is the inversion of 2-year Treasury notes and 10-year Treasury notes. So we're going to really look at that indicator because it has accurately called 10 recessions. So essentially 90% of the time, the 2-year inverts to the 10-year, we're going to have a recession. So we're going to look at the impacts of that recession. And we're also going to look at how long after the 10 and the 2 invert do we actually go into recession, because it's very important to prepare to do things before the recession and during a recession. So you guys, that's what we're going to dig in today. But always remember this: I am not a financial advisor. I am an opinion sharer, a realtor in Houston, and a loan officer in Texas. Having said that, please do me a favor right now for the algorithm. Like this video, subscribe to my channel if you haven't, and please comment on this video. I look at our videos and I look at my channel as a community, so I'm constantly being educated myself, and I see other subscribers interacting with each other. So please share your insights, share your experience, and be transparent with us, because here's the reality of this situation. It is an entirely new situation we're in. It is an entirely different housing market than we've ever experienced. So the more minds we get on this, the better off we are. First thing that we're going to do right now, guys, is we're going to look at the Fred economic data for essentially the 10-year and the 2-year inversion. So we're going to look at that. We're going to look at the history, and we're going to pinpoint how long after the 10 and the 2 invert does that lead to a recession. So take a look at this graph with me right now. Okay, guys, so here's the 10-year Treasury constant maturity minus the 2-year Treasury constant maturity. Now, what I need to point out is these gray lines here, that indicates a recession, okay? So basically we're looking at 6 recessions: recession here, recession here, recession here, recession here, recession here, okay? And essentially this black line here, anytime the 2-year inverts, it's going to go underneath this black line, okay? So the first recession that we're going to look at is essentially the recession right here, okay? So here's the first recession, the 1980 recession. And if you note, right here is when the 2 and the 10 inverted. So from the time the 2-year and 10-year inverted to the time that led to a recession, and this is interesting to note here, was approximately 1 year and 4 months to get to the first recession. Now, looking at the 1981 recession, they first inverted in September 1980. We went into a recession in 1981 of June. So essentially, this recession took 9 months to happen after the 2 and the 10 inverted. So let's go over to this recession here and this inversion. So this is the 1990 recession. The 10 and the 2 inverted approximately in December 1988. Recession took place July 1990, making this recession after inversion 1 year and 7 months. Let's look at this recession. Okay, here's the first inversion. Okay, this is the 2001 recession. First inversion was February 2000. Okay, and the recession February 2001, making it approximately 1 year after inversion for this recession to take place. Now let's look at the 2008 recession. Okay, it inverted January 2006, recession December of 2007, making this the longest time after inversion, which is 1 year and 11 months. Now also there's a little recession here from the COVID lockdowns. Again, it did invert. It inverted in August 2019. We went into a recession January of 2020, which is essentially 5 months after inversion led to a recession. So the reason why I'm showing you this, guys, is normally the 2 and the 10 is going to predict a recession. More than likely, we're going to go into a recession. And the question now remains, when will the recession occur? And if we go off of history, the longest it's taken for a recession to happen after the 2 and the 10 was almost 2 years. The shortest amount of time was 5 months. So it's possible, it's very, very possible that the recession actually starts in 2022 or 2023. So either way, 2022 or 2023, more than likely we're going to have a recession. Now, what I really want to focus on, guys, is if we have a recession, which we probably will, what will that do to home prices? So what we're going to do in order to analyze that is we're going to look at another Fred economic data chart at the median home prices, the average median home price across the United States. And we're going to look at the recessions and see if there was actually any loss of equity during those times. Let's get started. Okay, guys, so the same thing as before. All these gray lines here is the recession. Okay, these are all recessions. Okay, now here's what's interesting to note. So starting at the 1970 recession, which is right here, essentially Q3 of 1969, the median home price was $25,900. When we got out of the recession around Q4 of 1970, the home prices dropped to $22,600. So the 1970 recession ultimately led to a decline in equity of 12.5%. So this recession, we lost 12.5% during it. But here's what's really, really interesting, guys, and this is a little bit of a shocker to me. The next few recessions had no negative equity loss. And in certain situations, certain recessions, home value actually went up. Take a look at this. Okay, so the 1974 recession, home values actually went up. 1980 recession, no real loss. 1981 right here, no real loss in median home value. Okay, going to 1990 recession right here, there was a moderate loss. If you take the Q2 1990 median price, which is 126,800. When we got out of the recession, Q2 of 1991, it went down to 119,900, which is essentially a 5.4% equity loss. So a little bit of equity loss in 1990, going to 2000 right here. Here's a 2000 recession. Essentially, from Q2 of 2001 to Q4 of 2001, there was a 4.4% equity loss. Okay. Now let's go to the really big recession right here. Now, going from Q4 of 2007, the median home price was $238,400. Once we got out of the recession, Q3 of 2009, median home value had dropped to $214,300, which is essentially a 10% drop in median home value during the 2008 recession. Very interesting. Now, here's the little recession here. This is kind of an artificial recession, but essentially there was a 2% equity drop. So this is really important to point out, you guys. When we're going the average median home in the US, which you have to understand, that's just the average. There's certain cities that will have a very big, very drastic effect, whereas the average may be only a 10% loss. Certain cities, certain metro areas can lose 30, 40, 50%. So this is just an average. Some places more than others will be harmed severely. But overall, as you can see, a recession alone doesn't necessarily mean home prices will go down. I think it's important to notate that. Really, the only indicator that was really a sharp decline in median home values was the 1970 recession and the 2008 recession. So essentially, the fundamentals aren't necessarily there that would guarantee that if we go into a recession this year or next year, that will automatically create lower values for houses. However, we're in a housing market right now with wacky fundamentals. The fundamentals aren't really working in this housing market. So I believe in this specific housing market, a recession will ultimately lead to a bubble pop, because what we have is a supply and demand issue. So I want to look at something that will greatly affect the demand of housing going forward, which is a recession as far as the unemployment. So recession really badly affects unemployment rate, because businesses suffer for lack of profit. Things are more expensive. So let's look at the unemployment chart right now and see what happens to unemployment when a recession is going on. Okay, guys, again, remember these gray lines here, that's the recession, okay? That's the recession, recession, recession. And this is the unemployment rate. Okay. So you can see here's the 1973 recession. You can see that the unemployment skyrocketed here. Look at it, went up. Look at recession here, skyrocketed, recession here, skyrocketed, recession here, skyrocketed. So generally the unemployment is going to skyrocket through the recession. First recession, we had 3.8% increase in unemployment. 1980 recession, 1.5% increase. 1981, 3.6. 1990, 1.1. 2000, 1.2. 2008 was a lot more at 4.5. And the 2020 recession, look at this. This spiked up in unemployment, which has ultimately led to an additional 11.2% increase in unemployment. So historically, the fundamentals is all spelling out that if we do go into a recession, more than likely what will happen is it's going to soar the unemployment rate. When there are more and more potential buyers that go unemployment that are worrying about their job, they're not going to be as worried about purchasing a house. And right now, listen to what I'm saying, okay? And I want to give you guys my opinion. I'm not necessarily saying that a recession alone will drop the home prices. But what I am saying is 2022 has a housing market with essentially fundamentals that we don't even understand. So I believe that the housing market bubble will burst during the recession in this case, because I believe what's going to need to happen is not only we're waiting on supplies, new home builders, foreclosures, resale house. So we have these supplies going up, but there's still too much demand. So I believe if we go through that period of recession and the unemployment rate spikes, I think that's going to curve demand enough to finally burst the bubble. And you guys should know that we are absolutely in an asset bubble. We're absolutely in a housing market bubble because equity went up way too much, way too quickly. So my estimate, my opinion here is we're going to go into a recession first, probably this year. And after the recession has started, there will be a bubble burst or a housing market crash that will lead to an even worse recession, possibly a depression. So I'm kind of doubling down on the recession thing. Now, again, historically, the fundamentals aren't really there for a housing market crash to happen just because of the recession. But again, I say because buying demand is so high right now and prices are so inflated, they're so overpriced, there's such a big bubble. I think the recession is in this year, in 2022 or 2023, is going to lead to a housing market crash like we've never seen before. Now, it's interesting to point all of these things out, guys, because again, we don't know what's going to happen because we've never had a situation like this. We've never had COVID. We've never had so much money printing and so much investor and institutional investors taking our houses up. Now, I talked to some realtors today during class, and the market is still very much a toxic market. I'm in Texas. Texas is number one for new construction, so I get to see that, but it's also number one with migration. And a lot of these realtors that raise their hand, because I asked people if they're representing buyers, how's the situation going? One realtor raised her hand and said the last 7 buyers she had were not even local to Texas. So the migration is still continuing. It's still inflating prices. And she's also telling me they're going $25,000 to $50,000 over asking price to secure these houses. You guys, real estate goes in cycles. I know some people can't fathom a house drop, but they have always dropped. And again, I understand that a lot of people are emotional. You can't see the light at the tunnel, but it's going to be my overall opinion to sit tight, to buckle up. And if you do buy real estate right now, go in with the right mindset. Go in with the mindset holds for 7 to 10 years. Okay. But my opinion is definitely not to buy right now. Either way, guys, I hope this video kind of helps you as far as what a recession would do to a housing market, because it's not guaranteed that it will do anything. But I believe it will be a cause of a bubble pop because of the unemployment rate soaring, lowering demand even more. You guys, either way, I hope you like this video. If you're out there investing in real estate, I wish you luck and I hope you win.